Welcome everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back everyone. So on Friday, March 15th, on the 5-minute chart, AMC started out at a low of 421, got as high as 454, and then barcoded for the remainder of the day to finish at 444, up 17 cents or 3.98%, which was right where they needed it to close, safely under max pain of 450 on quadruple witching options expirations day. Now, over the past 5 days, we did gain 2.56%. Over the past month, we're down 7.5%. Over the past 3 months, we're off 33.83%, and year over year, we're down 89.15%. Now, the daily chart tells a very different story for Cinemark, one of our main competitors. Over the past week, they're up 6.48%, up 16.22% over the past month, up 19.48% over the past 3 months, and up 43.06% year over year. So why the big difference between the stock price of AMC and Cinemark? Well, really bad dumbass on Twitter might say Wall Street isn't picking on Cinemark and its CEO the way they pick on AMC and Adam reverse split Aaron. Well, let's see if that's true. Short interest ratio for AMC, 3.47 days to cover. What's the ratio for Cinemark? More than double, 8.16 days to cover. How about short interest as a percentage of the float? For AMC, I've got 12.11%. For Cinemark, double again, 25.20%. But those are all lies, Uncle Frank. Well, let's assume you're right. The real difference is Cinemark isn't run by Wall Street. That's all you need to realize so you can see this play for what it is, an enrichment scheme for Adam Aaron, his entire management team, and the entire board of directors. If you can't see that by now, it's because you don't want to. The ape was designed by Wall Street shorts for Wall Street shorts in our very own boardroom. The bottom line is it would be impossible for Wall Street to do what it does to this stock without the help of AMC management and the inaction of regulators. Once you see that, you'll begin to focus on the things that can actually give us a victory on this trade, not investment advice or advisor. It will be nothing Adam Aaron does. Everything he does hurts the price of the stock or impedes it from advancing. No, I've shifted my focus to events that will hurt our enemies, forcing them out of their trade, while also covering developments that keep the company on the road to full recovery. Okay, let's start out with some good news for theaters for a change. From Collider, all 8 Spider-Man movies returning to theaters this year for Sony 100. The live-action Spider-Man films starring Tom Holland, Andrew Garfield, and Tobey Maguire are swinging back onto the big screen. The re-release aims to boost Sony after Madam Web's underwhelming box office performance. Now, guys, on the right, you can see this all kicks off with the Spider-Man from 2002 on April 15th. So we've got something to look forward to that we didn't have previously. And here's a public service announcement for the dimwits that visit this channel and blindly support our pervert CEO who is susceptible to blackmail. I never said the man doesn't want the company to perform well. Every CEO does. It's the stock price advancing he has a problem with because it hurts the interests of Wall Street, and Wall Street runs this company. Now, here's an example of something I support that management is doing in light of the lack of content from Hollywood. A headline from the New York Times, no less. AMC Theaters, looking for movies, turns to Blumhouse. The theater chain and the entertainment company are teaming up for a 5-day festival of old horror films in 40 cities, compensating for a lack of new films. Now that's smart. AMC and Blumhouse, who's seen here on the right, which has made over 200 horror movies and shows, are teaming up for what they are calling the Halfway to Halloween Festival. Previous released Blumhouse horror movies including Split, Ouija, Origin of Evil, The Purge, The Invisible Man, and Insidious, which will have its 13th anniversary on April 1st, will be offered in 100 AMC theaters in 40 cities. And a little more good news. NBC Universal to offer a block of the NBC television network's live daytime coverage of the 2024 Paris Olympics in AMC theaters nationwide between July 27th and August 11th. Select hours of NBC's daytime coverage to be presented live as a ticketed event in approximately 160 AMC locations throughout the United States. NBCU's Olympic Games Paris 2024 promotional trailer to begin running in AMC theaters on March 29th. And here's some good news about our merchandising business. An idea created and fueled by the AMC apes. Can you still buy a Dune 2 popcorn bucket at AMC? Why, it's selling on eBay and Etsy for over $100. From the article, the most unique piece of movie merchandise has been the subject of countless memes, questionable comparisons, and even an entire Saturday Night Live skit. And it might soon be gone as the sequel to Dune enters its third week at the box office. Those who didn't purchase the infamous popcorn bucket might want to grab it before it's too late. Now, I will remind you, the Dune 2 popcorn bucket is an AMC Theaters exclusive piece of merchandise. And whatever we make on this promotion, Adam plans to blow the money on Nicole Kidman again, who we paid $25 million for a short film that runs in the theaters. Now, Celebrity Net Worth puts Nicole Kidman at $250 million, guys. Adam's only made $100 million over the past 5 years, but give him some time. He's not done bleeding as much as he can from this company. Okay, so here's the headline from Deadline. AMC Theaters enters Phase 2 of Nicole Kidman pre-show campaign with a trio of new spots. From the article, AMC's much talked about pre-show commercial starring in earnest Nicole Kidman in a glittery pantsuit will have 3 new iterations, CEO Adam Aarons said, as the exhibitor plans to start rotating a trio of 30-second spots in theaters nationwide, and that begins on March 1st. Now, guys, I sincerely hope we're not tossing millions of new dollars at this project. I think the money would be better spent on TV commercials promoting the A-List program, which is the best value out there in my opinion. Imagine a commercial where you compare a Hulu membership, which for me is around $89 per month with only one movie channel and live TV, compared to the A-List program, where you can see up to 3 movies per week on the big screen for around only $23 per month. Check out this headline from Box Office Pro. AMC Theaters invites movie fans to enjoy a month of movies for 99 cents when joining AMC's Stubbs A-List program. Wouldn't commercials on national TV regarding this program bring more people into the theater than just more spots featuring Nicole Kidman? And what do we have planned for the Easter weekend to close out this anemic first quarter? Here's a headline from Deadline for you. Bunnies get out of the way. Godzilla x Kong, the New Empire, to stomp on Easter weekend box office with a $45 million plus debut. From the article, after pouring over $200 million currently into the domestic box office with Dune Part 2, Legendary Entertainment and Warner Brothers have more cash to shower on exhibition with the Easter weekend March 29 release of Godzilla x Kong, the New Empire. Currently, Projections are at 45 million plus. Don't be shocked if it hits 50 million for the second Adam Wingard directed title in the legendary Monsterverse. At that level, in opening weekend, that will feasibly propel the Godzilla and Kong franchise past the $2 billion mark at the global box office. But the theaters are dead, right? Okay, so what do you have for us, Uncle Frank? Well, I'm very disappointed the Hedgies made it through last week and didn't step on one landmine. We have to be patient because we picked a fight with the most diabolical hedge funds on the planet, and they could break the securities rules and laws with impunity. What we're looking for is a swan event to land on a day where we have complex economic data coming out or where AMC has significant upward momentum, preferably all at the same time. We want a crisis in the leverage chains of our enemies, one that would force their prime brokers to turn on them. On Monday, March 11th, we had the Fed end the bank term funding program. Now, the effects of that we still may feel going ahead. On Tuesday the 12th, we had a hotter than expected CPI again. So that means the Fed may push out expectations for a rate cut. On Thursday the 14th, we had a hotter than expected PPI again. And Friday, we had quadruple witching expiration day, which was a complete dud for us AMC apes. Now, Tuesday and Wednesday of next week are the Fed meeting. No one expects any rate cuts or movement, but in the wake of two hotter inflation readings, the Fed may tell everyone that we may have to wait longer for one than previously imagined. Also, this coming week on Friday, March 22nd, that's the deadline for the SEC and Ripple to file briefs regarding the settlement. The SEC has a new deadline of May 6th to file its reply. So a regulator that doesn't regulate the securities markets worth a shit is regulating the crypto markets instead. Now, also on Friday the 22nd, the XRP ledger AMM is anticipated to go live. Guys, I didn't say I like it. Okay, I'm just reporting on it, so calm down. Maybe it'll be good for the coin. I don't particularly like the ETF either, but it could be good for the coin. I don't like when Wall Street butts into XRP or crypto for that matter, but I have to report on it. Hopefully, we get a surprise settlement soon so we can put this piece of shit Gary Gensler behind us and move on to dominating the world for cross-border payments, unlocking billions of badly needed liquidity as we do so. Now, when you hear regulators and politicians complaining about hedge fund leverage, that's good for us. If Moody's downgrades U.S. debt from AAA, that will be a significant day. And if you hear people start calling for a ban on shorting banks and or financials, that will mean it's on like Donkey Kong. So be listening for that. Now, the hedgies aren't out of the woods just yet. After the Fed meeting, all eyes will turn to Friday the 29th. Not just because Godzilla vs. Kong is being released in theaters and I expect 3 million apes to go and see it, but that's when PCE comes out, the Fed's favorite indicator, and I can't see how it's going to be good news. So Friday, March 29th, be looking for U.S. trade balances, advanced retail inventories, advanced wholesale inventories, personal income and spending, and then the entire PCE group. The 29th is going to be a big day. Now, speaking of Ripple XRP, I've got a couple interesting slides for you, like this one from Whale Watcher Guru. Ripple XRP ETF is around the corner, executive says. But what executive said it? Uphold Bank executive Martin Hisbeck is optimistic that Ripple XRP is set for a major rise and hints that an XRP ETF is around the corner. Speaking on Twitter about XRP's bullish trend as of late, Hisbeck says that the surge is linked to further development of the token. This development could be the work of a new XRP ETF to join the family of ETF cryptocurrencies. Hisbeck believes that the development of XRP will build up following the conclusion of Ripple Labs' case against the SEC. In February 2024, Ripple CEO Brad Garlinghouse addressed the potential launch of an XRP ETF. With the approval of spot Bitcoin ETFs and rumblings of an Ethereum ETF, XRP is a likely candidate to be next due to its rapid growth and trading volume. Now, this is not financial advice. I am not a financial advisor. I will never tell you to buy, sell, or hold any security or cryptocurrency, but it's headlines like these that get me excited about Ripple XRP. American Institute of Physics acknowledges Ripple and XRP for disrupting cross-border payments. Guys, I don't see other coins, even ones that I like, getting headlines like this. Not Shiba Inu or Doge or Taco Cat. These kind of headlines are typically reserved for Ripple XRP. So as we move into the Fed meeting this week, let's review the swan-related headlines that are presently in the air from MarketWatch. 10-year Treasury yield sees biggest weekly advance since October after hot U.S. data. Treasury yields finished mostly higher on Friday, handing the 10-year rate its biggest weekly advance in almost 5 months, as traders continue to absorb February's producer and consumer prices data. I almost feel bad for this guy now. Half the world is screaming for a rate cut while inflation just keeps ticking back up. From the UBJ, Powell at a crossroads amid resurgence of inflation. Former governor urges Fed to act swiftly on rate cuts. The upcoming FOMC meeting, scheduled for March 19th and 20th, is expected to keep the markets on edge due to its significance. While interest rate decisions are widely anticipated to remain unchanged, and that's at 5.25 to 5.5, the focus will be on two key factors. First, the release of updated macroeconomic projections, including the dot plot, which outlines the Fed's anticipated path for interest rates. Second, market participants will closely watch Fed Chair Jay Powell's remarks during the subsequent press conference. And I wonder if this word is going to surface at the upcoming Fed meeting: stagflation. The U.S. economy is sinking into a 1970s-style dilemma where inflation sticks around but the economy cools, and investors are ignoring it at their own peril, according to a top equity strategist at B of A. Signs that the U.S. economy is flipping from Goldilocks to stagflation have multiplied recently, according to Michael Hartnett, a B of A global equity strategist. The shift could have serious ramifications for the stock market that many investors aren't yet taking seriously. Now, guys, this is right on cue. We're counting on hedge fund greed and recklessness right now as hedge funds ramp up leverage to near record highs to juice returns. Hedge funds' use of leverage in equities trading is near record levels after debt-fueled strategies ballooned in recent years and an upturn in financial markets prompted riskier bets, according to two banking sources and recent client notes from major banks. And what did we learn last week, guys? From Goldman, hedge funds snap up stocks at fastest pace in 11 months. So now we know the hedgies are balls deep long again and have dialed up their leverage. So what is Uncle Frank rooting for? A surprise event that will rug pull the markets and take the hedgy whales into shallow waters where they'll get stuck on the sand and we can kill some of them. And an article from Michael Thrasher, why this January was the worst for hedge fund flows in years. Investors redeemed an estimated $14.3 billion more than they gave to hedge funds at the start of the year. That's what we want, guys. Their leverage is sky high. No new money coming in. No one to borrow more from. And then my favorite, hedgy clients asking for their money back. That's called redemptions, the R word for our enemies. And from Charles Payne's show, Making Money, Fed's rate cut promise caused banks to drastically mismark their books. You see, guys, just because they want one doesn't mean they'll get one, but they're already acting like rates have receded. The Bear Traps report founder, Larry McDonald, says the New York Community Bank collapse speaks to a greater economic problem. And the next slide will tell you we have more contagion ahead from the commercial real estate crisis, and more bond defaults means moving losses from the unrealized column over to the realized one. You don't have to take my word for it. Let's start with this one from Bloomberg. Commercial real estate market plunge has lenders facing a brutal reality. Business Insider. Commercial real estate's in big trouble, may have major financial fallout. And then Fox Business. Commercial real estate trouble could trigger systemic credit crash, fund managers say. Now, the financial media only wheels out these guys when they can smell trouble coming. From Business Insider only 3 days ago, Black Swan fund manager Mark Spitznagel expects the stock market to rally further before we hit the worst crash since 1929. He explains how investors should think about their portfolios to survive the next few years. And just from last week, these guys are putting their reputations on the line and making their calls. From Yahoo Finance, a private equity black swan event poses huge risk to markets. Risks from investments in private equity lurking in the shadows. From the article, investors and fund managers are always on their toes, trying to anticipate when and where risk will appear next. The biggest source of market risk comes from major black swan events, unpredictable events or phenomena that drag markets lower. Universa Investments COO Brandon Yarkin discusses how his firm mitigates risk for clients, including in private equity categories and pension holdings. Now that we have this context of portfolios that are built a certain way, we look at the financial landscape as being incredibly leveraged. There's a tremendous amount of debt, Yarkin tells Yahoo Finance, adding, and we've seen the Fed Reserve raise interest rates as quickly as they ever have. So that has specific lag effects, and one of the most visible lag effects that we've seen is on private equity. And let's not forget Black Swan author Nassim Taleb, who correctly called the 2008 financial crisis, says the U.S. is in a death spiral over government debt. Now, I covered this article in a previous video, but it bears repeating. From Fortune, top real estate mogul warns 500 or more banks will either fail or be consolidated over the next 2 years. But then this came out. Bank failures are coming, according to Fed Chair Jay Powell. Jay Powell said that small and medium-sized banks were most at risk. He said, it's not a first-order issue for any of the very large banks. Quote, we're working with them. What does that tell you guys? The head of the Fed admitted to Congress that bank failures are coming. He said he's working with the big banks, so not to worry, and they're going to let the little banks suffocate because that's been the plan all along. Now, if you're an ape, you probably heard about this one last week. JP Morgan fined almost $350 million for issues with trade surveillance program. The Office of the Comptroller of the Currencies said Thursday that it was assessing a $250 million civil penalty against JP Morgan Chase Bank because it found that the company, quote, operated with gaps in trading venue coverage and without adequate data controls required to maintain an effective trade surveillance program. The OCC said it found that JP Morgan failed to monitor billions of instances of trading activity on at least 30 global trading venues. It issued a cease and desist order that required JP Morgan to take corrective actions to improve its program. Under the order, the bank must correct the deficiencies, seek approval from the OCC before onboarding new trading venues, and find an independent third party to perform a trade surveillance program assessment. The OCC said that the penalty has been paid to the Treasury Department. Separately, the Fed Reserve Board fined JP Morgan about $98.2 million for the program deficiencies, which it said took place between 2014 and last year. JP Morgan did not immediately respond to a request seeking comment. Now pay attention, guys. They're giving us hints from Forex Live. Goldman Sachs sees a big jump in volatility coming in April, says to buy calls on the VIX from Thursday. The VIX is jumping today as the stock market slumps, but analysts at Goldman Sachs think it could rise much further from here. The volatility index offers a good hedge on stock markets as it rises exponentially as equities fall. Goldman Sachs says its volatility model sees an average of 21.5 on the VIX in April compared to the current level of 15. And I don't remember seeing this story on CNBC or Fox Business. BRICS, 10 local currencies, outperformed the US dollar this week. The US dollar remains on a slippery slope due to macroeconomic pressures. The prices of gold, commodities, Bitcoin, and the broader cryptocurrency market are rising, while the US dollar is dipping. Around 10 local currencies have outperformed the US dollar this past week, including that of 2 BRICS countries. I have only this parting comment. I don't know about you, but my credit card payments have doubled and tripled. I haven't missed any mortgage payments, of course, but I haven't been paying that thing on the first of the month anymore, if you know what I mean. While the United States economy has avoided a recession and unemployment has remained low, that doesn't mean everyone is having an easy time of it. Some Americans feel increasingly pressured by the surge in the cost of carrying their debt. Delinquency rates on their credit card debt and auto loans are now at the highest in more than a decade. This chart from Bloomberg shows lowest earners saw biggest increase in delinquencies. This is coming to a head, people. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.